Traders, Cousin Vinny coming to you from theclosingprint.com on January the 19th, 2020. In this edition of your weekend video newsletter, we'll discuss the indices, which are at extremes, at all-time highs, and a bit overbought in my humble opinion. We'll look at the big cap tech names. Most of them moved higher with the exception of Amazon last week for some potential trades. We'll also focus on fewer names as we trade near all-time highs. We still see a large number of stocks breaking out every day. Until those start to fail en masse, we have to consider the market as bullish. We'll then look for failure. The bond stock ratio is bullish. High yield and junk bonds are printing dojis on the weekly, so that could show a sign of a pivot high. We'll keep an eye out for that. The Dow Composite is bullish, the S&P 1500 is bullish on a buy signal, and the XII is trending between the standard deviation 1 and 2 bands. No blue sticks, only green lately. That's a good sign. Tick and Tick Q turned back up on Thursday late into Friday. We have a green bullish signal now. NYMO and NAMO are still showing a plateau. That doesn't mean it can't turn back up, and it's not an end-all signal in itself, but we need to keep an eye on NYMO and NAMO because we want to see breadth improving, not fading. Book call ratio is neutral. VIX is near lows. The US dollar did move higher last week, closing near the upper part of a descending wedge. We'll talk about that. That should put pressure on gold and commodities, which have been consolidating recent gains. Copper's in a higher high, higher low situation, trending, and we saw crude oil cascading lower over the past week. The heat map is improving. We saw strength in internet, real estate, telecom, technology, industrials, and a few other sectors. Weakness in energy and materials persists. Heat map is also improving for Europe, China, the USMCA having an effect on Canada and Mexico in particular, which had a very good week. We'll look at some IBD 50 names. Notice there are fewer, and some Market Smith Growth 250 and stocks in the top 20 volume percent gainer category. Bukowski is showing 505 green with a CPI signal green since January 17th at 77.8%. That's bullish actually, with 14 bearish patterns, 49 bullish patterns, and 260 patterns waiting for breakout this week. Bottom line, once again, the markets are a bit extended, so we'll be focused on fewer names. It doesn't mean if you're trading something other than what we're trading, it won't work. It just means that we'll be trading fewer names than we've been since the October reversal going into the week. The ARCA Institutional Index has been a good barometer for us lately. Over the last few months, since the October reversal, it's managed to stay above the 21-day and spent most of the time between standard deviation 1 and standard deviation 2, while printing blue and green elder sticks. We're still looking for red sticks to give us a sign that we need to start selling and managing our positions at all-time highs, as we anticipate a reversal in the short term. Each week we also focus on breadth, which is encompassed in this particular chart, the S&P 1500 composite, new highs minus new lows percent on a cumulative basis. This line continues to rise, telling you that cumulatively, more stocks from this group, the S&P 500, S&P Mid-Cap 400, S&P Small Cap 600, continue to rise and close near the upper half of their daily ranges each week. We continue to produce green and blue elder sticks. Histogram is rising rapidly, so the next direction would most likely be a peak and a reversal. So we're very focused on a potential red stick or two, which would tell us to start managing our positions more actively and reduce our exposure and risk to the markets. With the previous chart of the S&P 1500, new highs minus new lows percent, cumulative advancing, we can also break those three down into the advanced decline percent cumulative for the S&P 500, S&P mid cap 400 in the middle, S&P small cap in the lower panel. We can surmise just by the fact that these are making new highs that we should remain bullish until we start to see a series of lower highs and lower lows like we did back here in 2018 before we start to assume that the markets are going to start pulling back anything more than 1% or 2 during this current uptrend. That said, we do have something of a caveat in this particular chart of the S&P 500. On an equal weight basis, we are making new highs. Bollinger Bands are opening up top and bottom, which is telling us to expect a fast and accelerated move as volatility increases. The thing that has my attention is the S&P 500 A50R, the number of stocks trading above their 50-period moving average, has now reached the red zone. It does not mean that will reverse immediately, but it's something to watch like we did back here in April and in late July of 2018. We eventually made a high and started to reverse. So we want to keep an eye on this particular indicator. As we noted in the opening monologue, all of the big cap tech names, with the exception of Amazon, were moving higher last week. We did see some performers in big cap biotech as well. As a result, the NASDAQ weekly continues to rise rapidly. We're showing muscle. These are the strongest months of the year, so this could continue into April and May. Sell in May and go away comes to mind. In addition, we saw IWM moving higher. I know David and Ken were positioned in IWM last week, among others in the trading room. Testing the all-time highs is what we were anticipating. Now we're looking for signs of either a double top or a breakout and continuation in this risk-on indicator, showing that investors' appetite for small-cap stocks continues unabated, while the Wilshire 5000, a broad measure of market participation, reaches overbought territory, very extended. We can see that the Copoc cycle is near the red zone. It doesn't mean that we reverse immediately. As we can see back here in early 2019, we got overbought, but we did continue higher for a few more weeks before pulling back 7.6% and 7.5% over here. Those were related to tariffs in both cases. So look at the volume. We are extended, but could potentially move a bit higher before we start to see a reversal. There's no divergence here. Wilshire continues to press the upper edges of the envelope as well. Most likely a result of people with new jobs that continue to invest in 401ks. The millennials that we discussed recently last week in our blog post, covering the idea that the boomers participated in waves after graduating college, new jobs that led to opening 401ks, investing in the markets with the additional capital that we had, buying homes, getting married, having kids, buying new cars, etc. So we're on the first wave right now. We're in like year 3 or 4 of the current millennial expansion, mirroring what we did as boomers. They'll go through the same life cycle, which means if we have a similar period, we could see another 16 years or so in this particular cycle and expansion in the markets, with periods where we see drawdowns of 5 to 10 to 20% as a normal course during the millennials' lifespans. VIX on the 60-minute time frame is on a buy signal. We are at lows which could persist for a while. Previous occasions where we hit these lows led to rollovers in the market, so just be aware of it. That's why we're trading fewer positions. And we can also see the front month to the 3-month VIX volatility indexes showing us reasons to be more bullish. We're in the neutral zone but drifting lower, so we're closer to a potential top, obviously, and should trade more cautiously bullish as a result. That's also reflected in skew, which continues to rise, suggesting with these higher highs and higher lows that institutions have begun hedging, though not massively, giving us a reason to be cautious as well. While the NYHL new highs minus new lows on the New York Stock Exchange continues to thrust higher on Friday, moving average is rising, so we're looking for a reversal in this indicator in the short term. Still above the zero line, not looking for a sell signal, just a reason to be more cautious, as everyone seems to be overly optimistic at this point. Therefore, with that optimism, you would expect to see more calls being bought than puts. We can see that in the put call ratio. When it's in the red zone, that's telling us to be cautious. Look for either sideways action or pullbacks in the short term, as more calls are being bought than puts. People are a bit too complacent and being set up to be disappointed when it reaches these extreme conditions. The bond stock ratio between the 10-year US Treasury bond and the S&P 500 continues to drop. We can see the moving average is rolling over, like we saw back in late 2016, which led to one of the best years in my trading career. We do see a similar setup at the present time as the S&P 500 continues to rally, no red sticks, and the bond stock ratio continues to drop. This chart is bullish, showing that investors and institutions alike are more bullish equities than bonds at the present time. That said, junk bonds, a measure of risk in the markets, is showing a doji pattern at highs on this weekly time frame, which suggests, together with RSI, that we are overbought. The potential for a pullback is greater than it was when it pushed off the 20-day moving average and started to rise back in November and December. High yield corporate debt is showing the same condition. TLT also remains in this descending channel or wedge pattern, closing below the 21-day. Most likely will stay range bound, while AGG, the Barclays Aggregate Bond Fund, remains at highs as well. We have a position in this particular asset in our retirement account, remaining at highs, reluctant to pull back at all, which is very unusual, as price remains elevated, 2.5 times the size of the equity market, so bonds are important. This is the benchmark that bond traders use as an asset class, so we want to keep an eye on this. The 10-year yield also reversed late last year, continues to show signs of rising. Consolidated recent gains over the last few weeks at the 182 mark, 1.82% on the 10-year yield. Looking for this to continue higher, similar to what we've seen in the past. Back in 2012, we had a consolidation of the run-up, pushes higher, consolidates, and then finally rolled over. Once the momentum slowed at a peak, we're nowhere near a peak on the PPO, so we're watching that. As the S&P 500 rises in each case, we can see that we're rising rapidly, just making me feel a bit uneasy as we continue to move higher. It's just crazy how the markets will rally with the 10-year yield. So keep an eye on the 10-year yield and bonds this week. And remember, the bond market is 2.5 times the size of the equity market, while the currency market dwarfs both. Forex, foreign exchange market, or currency market trades in the trillions of dollars each day. We do see the US dollar here rising back up to the 50 and 200-day moving averages. I would anticipate it could get rejected here and roll over. Maybe it pushes a bit higher and hits this upper trend line or tests these lows or these highs right in here that we saw back in November and December. RSI suggests that we could see a bit higher. That's a function of price. So watch the US dollar. If the dollar does roll over, that would be good for commodities. in particular gold, which I see a lot of people talking about the gold trade this past couple of weeks. This is the S&P 500 gold ratio. As this drops, this is telling you that gold is underperforming the S&P. And if we look at the gold chart, it tells us a pretty bullish picture actually. Price action rising out of this descending channel over the last several weeks, above volume by price bands. If it can't get back above these highs and gets rejected as a double top, that would probably be a result of the US dollar continuing to rally up to that upper trend line or a bit higher. If the dollar does drop back down into that descending channel or wedge pattern, expect to see gold breaking higher. As gold reaches those highs, however, these shorts would have to cover. These are commercial shorts. These are the big guys using shorts to hedge their positions. We can see that small speculators right here are net long, and how those speculators' longs have decreased over the last reporting period from January 14th to January 17th. They took a lot of those positions off as the market started to move a bit higher. And if you look at these two numbers here, long and short, you can see this is pretty much flat or neutral at the present time, and the changes are about equal in open interest. Bottom line, we're watching what gold price does this week, and we'll trade it accordingly. That leads us to the copper monthly chart, which is showing improvement, moving off of this support level, consolidation zone, right around 260. We're looking for a break higher. That would be good for housing, construction, and building supply. This is a forward-looking indicator. Higher is bullish for the economy, lower is bearish for the economy. You can see what we did back in 2009 when the markets reversed, March 2009. So this commodity started moving higher before the markets reversed. Again, a forward-looking indicator. Again, in 2016, after the election, the markets ripped higher. We're looking for something similar going into this election year. That segues nicely into the homebuilders ETF XHB. We can see that this is moving higher, a reflection of that increase in mortgage applications. I believe it was 30% year over year, an increase of mortgage applications indicating that perhaps millennials are starting to buy their first homes. Remember that millennial multiple expansion chart we discussed earlier in this week's video? That said, it won't be a straight shot to the moon. We're going to see backing and filling, most likely going to see a pullback in the short term, which would give us another entry in a lot of those building stocks that we were looking at this week, like Lennar, which bolted higher over the last 2 weeks, and Hovnanian Enterprises, which we traded midweek, giving us a nice gain back up to these recent highs. A triple top breakout is what we're anticipating, or a rejection in the short term. Here are the sectors. We can see that they're all above the 20 and 50-day moving average, with the exception of energy, XLE, with the most bullish of them quite extended, but could continue higher. So we'll be focused on the sectors that are showing relative strength going into this week. Keep in mind that with the IBD 50 list, that there's only 10 listed in the opening monologue that are set up properly, that aren't extended. It doesn't mean some of these stocks like Arch Capital won't continue to move higher, and therefore could be day trades, setting them up intraday with ABCD patterns, or trade of the day setups for entry, exits, and stops. We are a bit overbought, but we can see the relative strength coming out of this little shallow saucer shape pattern handle and breaking out. These are continuation patterns. MACD's above the signal line, volumes increasing, and standard deviation is rising. Therefore, while many of these stocks like Adobe, ACGL, etc. are extended, it doesn't mean they can't be traded intraday. We do like stocks like Baba that have pulled back to the 9 EMA and found buyers. We'll most likely see a bullish follow through this week, as many of the Chinese stocks have been oversold and represent bargains coming off the lows, well below 52-week highs. Stocks like Euronet coming back to the 9 EMA, finding buyers, really nice setup, looking for a continuation follow through breakout of this range. You see these wicks right here. On a break above these wicks, we would anticipate follow through up to this upper ATR band at a minimum, 167.51, or these recent highs going into earnings, as MACD is above its signal line and RSI suggests increasing strength. Ascent Group is also looking pretty interesting. ESNT moved back above the 21-day moving average. RSI rising through 50, so we're looking for continuation and a move up to this level right in here where it lost support right along that 5350, 5375 zone. Volume increasing, MACD crossing, telling you that we're most likely going to see a continuation this week in ESNT. Healthcare stocks broke out to fresh 52-week highs this week. As such, a lot of these stocks like Edwards Life Sciences will most likely continue higher. RSI is rising. We'd look for this 247, 250 zone in the short term. Not a big mover. Sometimes it gets moving. Other times it's consolidating. Volume's increasing though. RSI is rising and MACD has crossed above its signal line. So we're watching this one as well. InMode is an Israeli company that's in the healthcare, medical, fitness, and well-being industry groups. Continues to push above the 9 EMA. The 9 is crossed through the 21-day. Breaking above this descending wedge, a bullish pattern last week. We're looking for a couple of bullish days to get back to 58, maybe 60, as RSI continues to project higher prices. Volume showing institutions have been buying, and we have MACD above its signal line and rising. Netflix has earnings after the close on Tuesday. Watch this one. It could have a big impact on the XLC communication sector and stocks in the group, as Disney has been an underperformer. We took that position off. It just couldn't get any legs this week. While stocks like Planet Fitness did pull back to the recent support holding, there is a potential it could pull back to the 9 EMA first, though buyers have been showing up right around this 79 level at the lows of these four candles. We closed at that high on Monday and then held that level all through the week. The 9 EMA continues to rise, MACD is above its signal line, and RSI is showing muscle. StoneCo also seeing a lot of people talking about this one last week. Towards the end of the week, Friday, it was pretty active. Watching for RSI to rise. Maybe we break out of this pattern finally. This is earnings over here, this big white candle. Looking for some signs of a continuation in the short term, as that chatter on Friday is leading me to believe people are looking for a breakout. XP, a recent IPO and on the IBD 50 this week. Looking for a follow through. We see where sellers came in just shy of 40, where people after the IPO were disappointed. It started to drift a bit lower. So these people right here are selling to anyone that's buying. If we do break above 40.50, look for a breakout and a follow through on XP. Zito Express, we talked about this one last week. It was consolidating above the 21-day, started to move above the 9 EMA on Thursday. Follow through breakout on Friday. RSI suggests that we could see a continuation up to that 24.62 and beyond in the short term. We're also looking at a few names on the MarketSmith Growth 250 showing relative strength. We can see ConAgra here reversing off the 21-day after consolidating there for a week. Most likely this will run right back up to the highs. Leastar trading some options on the run up here. Waiting for this pullback to the 21-day now to get started again. RSI is rising, volume increasing, MACD's turning. Most likely see a few days of upside this week, maybe a day trade. Freshpet, FRPT, something that caught my attention here. Look at the change in earnings 2019 into 2020. A huge increase, 999% estimated. Looking at the numbers here, not bad, but could be better. Looking for this one to continue to outperform. The company manufactures fresh pet food sold via company-owned refrigerators in over 19,500 stores across North America. So this seems to be a trend where people are taking care of their pets, with everyone knowing someone who treats their pets like their own children. I'm sure you know someone. As such, they're feeding their pets a better diet. So I would imagine this stock will continue to rise. Maybe a day trade. A lot of these stocks that are extended, I would only look at as a day trade, not as a swing, because the possibility of a pullback short term is very elevated. IPHI showing relative strength, continues to rise along the 9 EMA. Volume looking pretty good. MACD above its signal line. Kansas City Southern, I know a number of you were trading this over the past week. Cat Trader, I believe, was in it. Above average volume on Friday. Nice little blast higher here. Watch some of the other names in the group as well. CSX, building the right side of what could be a cup pattern. NSC, Norfolk Southern, blasting off as well. CNI, Canadian National, breaking out of a triple top. As the Dow Jones Rail Index breaks out, no doubt reflecting an increase in durable goods. Canada, Mexico also with the USMCA will be affected. Canadian Pacific continues to trend. This one looks really good. Not too extended. Looks like it's just going to continue trending. Pull back to the 9 EMA on Friday. Look for a breakout of this stock as well. All transports are not affected equally, though. We did see the bulk shippers, which had a great summer, sell off. This is a monthly chart. So the shippers aren't participating. Some of the stocks showing above average volume on the list this week that we're watching. BASI, inexpensive stock that looks like it's breaking out in the short term. Eros, one that we've traded recently, trading above average volume, greater than 100%. You can see earnings coming up in 37 days, breaking the 200 period moving average and rising. That might be something, a cheap stock to benefit from the streaming, in this case, Indian language films in multiple formats worldwide. Kala Pharmaceuticals breaking out as well. Another stock showing above average volume. LSCC, last week, there was a rumor that Apple might buy this particular company. Broke out of a nice flat base. Followed through. Some of you traded this one. Qualcomm also on the above average volume. Nice little spike on Friday. Breaking out of this double, triple top pattern. Looking for higher prices going into earnings 17 days out. Okay, traders, that's going to do it for me. This is Cousin Vinny coming to you from theclosingprint.com with your weekend video newsletter for January the 19th, 2020. I'll send out a watch list later tonight, 11:30 on the East Coast, 8:30 on the West Coast. We have no trade tomorrow. Just keep in mind that we are trading at all-time highs. The markets are a bit extended. We'll be trading fewer names just so that it's easier to manage if the markets do make a quick reversal, that we won't be stuck trying to manage 12, 15, 18 positions. So just keep that in mind when I keep repeating that we're trading fewer positions, selling into strength and such. All right, take care. Have a great weekend. I hope this helps. We'll talk to you soon.